So we are excited to be here today on our latest episode of Off the Page with Stephanie Aliaga. Stephanie is a global market strategist at JP Morgan Asset Management based in New York. Stephanie helps formulate and communicate economic views, deliver timely commentary, and maintain forecasting models for the firm. Her latest research is focused on issues related to the U.S. economy and artificial intelligence, which we want to talk about today. So Stephanie, first of all, thank you so much for being here with us today.
Of course, it's my pleasure. Thanks for having me.
And so Chris Ross of Alliance is also here. And maybe just to kick it off, to explain to listeners, why are we here and why are we talking to Stephanie? But as an independent firm, we have the ability to partner with outside leaders in the industry like JP Morgan. So maybe just talk about that, and then we'll get into this conversation we want to have today with Stephanie about artificial intelligence, the economy, and how it'll impact markets and investors.
Yeah, I mean, Alliance has the unique opportunity to partner with a lot of asset management firms across our industry, and those firms help us a lot with our portfolio construction process, and market research, information on the economy. We've worked with JP Morgan. We consider them a market leader in that space. We worked with them for many, many years and one of our trusted partners. So Stephanie, thank you for joining us.
And my first employer.
Your first employer, for sure. Forgot about that.
So, Stephanie, I think the first area of the conversation, like, if you turn on the news, if you open the newspaper, or you search Twitter, just AI is everywhere, right? And I think that goes for people certainly in the investing world day to day, but even those who don't work in the financial world are, I think, getting hit over the head with it all the time. And so providing context around the investing landscape during this sort of early innings of AI, and then understanding, like, okay, how does that impact our decision-making process as investors? So where I wanted to start was, I think, the perfect visual from one of JP Morgan's own research reports that just shows really how much people are talking about it. And so sort of since the launch of OpenAI and ChatGPT, you've really seen everybody in the S&P 500 come around to talking about it. So can you just explain for listeners and viewers what this chart means, and how you interpret this information?
Absolutely. So that slide that you're referring to, which just shows, the share of S&P 500 management teams mentioning AI. The first time that we used this chart, we put it together, honestly, was at the beginning of 2023. And we were still actually trying to convince people that AI wasn't just another kind of fad when it comes to technology, something like the metaverse, or even all of the fanfare around crypto in its early innings. And we used to show this slide and show the mentions of S&P 500 companies of crypto, which I think peaked at only maybe 13, 15%. It was nothing to the same magnitude. But what this slide shows, alternatively, is just how much of a focus this has become and grown for the major management teams of the S&P 500. And if you pair this with not just the headlines on CNBC and stuff, companies talking the talk, maybe they're just talking about AI to really like join the AI party. But if you pair that with the investment dollars that have been going towards AI, with some of the survey measures of CIOs saying that they have increased their IT budgets this year, and they're continuing to increase those projections over the next couple of years. It really just, I think, for us, adds greater evidence that AI seems well positioned to grow and scale over the next coming years. But to your earlier question on, what is the significance for investors, I'd say there's almost like kind of two stories going on right now when it comes to AI. One is the exciting, secular, technological transformation story. AI is going to change a lot of what we do in our day to day. We're at the very early innings of really figuring out how to properly harness this technology and integrate it into our workflow, our work days, into the businesses that are dominating the index and are kind of the industries that are growing the most. But then the other story that is going on, the first one, I think, very early innings, it has a long ways to go. The second one is just what we've seen in the market over the last year and a half. And that has to do with just the few companies that are leading the way in selling the picks and the shovels when it comes to AI. And, that's been an analogy that has been used quite often for those listeners not familiar. Kind of the way the saying goes, at the beginning, in the middle of a gold rush, everyone is trying to get rich by striking gold. There's some people that do, and there's plenty that don't, right? In some ways, you can think of that as the adopters of AI. Like some are going to be the ones that really use that technology to grow their market share. But the ones that are sure to make lots of profits are the ones selling everyone picks and shovels. And what we've seen in the last year and a half is that the companies selling picks and shovels are the large tech incumbents that have invested in the technological know-how to produce these things. They have the cash on their balance sheets to continue to invest over the next couple of years, and they're selling picks and shovels today. So it doesn't even matter who's getting, rich by striking gold. Selling picks and shovels is an incredibly profitable business. And so those companies have seen this really remarkable price appreciation in their stock performance. I mean, these are the Mag 7 companies or the Fab 5 or just one, whatever, however you want to slice and dice it. But the reason why investors have to really be really familiar with the AI story now is just because these companies have an outsized impact on the overall equity markets. I mean, we're recording this on September 4th, and yesterday was the biggest market sell-off that we've seen since August 5th, and that was driven by Nvidia. And Nvidia accounts alone for 8% of market cap. So there's a lot that we'll get into on the AI conversation, but I think that alone just underscores how important it is for all of us to follow this trajectory, the narrative when it comes to AI companies. And in some ways, NVIDIA's earnings are almost as important or more important than the jobs reports and, Powell speaking because of that impact it has. Yeah.
You talked about, you hit on a few different things there. And the one that I think I wanted to talk about was it's sort of identifying what's real versus what's not in the early innings, right? And if Wall Street is anything, it's certainly good at pushing product and slapping labels on things. And I think to a certain degree, that is what you've seen even from some of these S&P 500 executives, right? Of everything is an AI initiative. Everything's an AI initiative. So how do you tell in the early innings here? And I think you mentioned it in terms of there's a lot of people buying picks and shovels, so that's a good place to start. But there's certainly window dressing to a certain degree here too, right?
Sure. Yeah.
Go ahead.
And I think there is where it gets really, really tricky because a lot of the adopters of the technology, it's going to take time for a lot of these investments to, end up turning a profit. I mean, it depends. If you're not in the picks and shovels business, if you're in the kind of trying to adopt the technology, you're a financial services company and you're trying to be that one that just uses AI in the most savvy way that actually grows market share or allows you to slash a price premium, right? All of that, I think we still have very little visibility on. Now, I do think that I speak with a lot of our portfolio managers in the space, really, looking at company management teams in both growth and value sectors, and there are companies using AI in really, really exciting ways. But it will, I think each of those stories will be very differentiated. Our view is right now, when we think about the investment opportunity with AI, though, we're not focused on that. That is like the 2.0 story that over the next many years, I think will come into greater visibility. There will probably be some early winners, early adopters, but for us, the more clear investment opportunity here is in the AI 1.0. It's in the broadening out of those picks and shovels.
Right.
It's in realizing to create one pick, you need materials sourced from all over the world. You need a machine to create those picks that comes from a company in Europe, or you send it off the design to the pick over to a company in Taiwan. There's examples like that. And not just that, but it's also when you think about all of the investment in the build out in US data centers right now. I mean, the other big question that we're asking is, okay, that's great. We're going to have all this construction, new construction data centers. Where are you going to plug it in? There is this.
Yeah, the energy story is just it's hard to comprehend.
Absolutely. So that's what we're finding, I think, the more clear investment opportunities today, because we still want to be laser focused on quality and companies that are actually profitable right now when it comes to AI.
So the other piece of it, and I think one of the reasons we do this off the page is because many of our clients they're not living in this day-to-day world. Like it's this is what they pay us to do, right? I don't really care, and I'm not interested in it. But the other part of the research that we found really interesting when we dug in preparing for this conversation was around the workforce and productivity for sort of no matter what industry you're working in day to day, and that was something that Chris was going to mention and had a question about.
Yeah, no, I just think that you said there's a lot of money going in, investment from businesses. I see this in our industry. I even see this at Alliance. We recently invested in some technology to help us be more productive with our meetings, right? To help focus on client solutions. I did read a stat,
and it is mind blowing.
It is
it's real.
Yeah, we did a few demos before. It took us a long time to grasp it, and it does certainly add some value. But one of your JP Morgan's research talked about I guess between I think 5 and 20% of tasks in the economy could potentially be automated over the next 10 years. And I just wanted to ask your input on, is that a threat to the workforce and jobs? Or should we be looking at that as an opportunity to be innovative and experience some growth there? So I think that's what the feedback is when I listen to investors and clients. Should I be worried about this? Should I be worried about my job? So I just wanted to hear your thoughts on that.
And those are the headlines that get the clicks, right?
Yeah, for sure, for sure.
Yeah, they are. And there's a few things I want to say to that. The first one on the headlines, I think we've seen a lot of those over the last year. The one headline, for instance, said that Klarna, the buy now, pay later company, is using a chatbot to man its phone lines. And the headline was, Klarna's chatbot does the work of 700 full-time agents. And that spooks some fears, and it's like, oh, does that mean 700 jobs lost? We don't think it does. And I think history is such an important guide when it comes to this, because automation is no new phenomenon. Like, we as a species are just really good at finding smarter, better, faster ways of doing things, and in training machines or equipment to help us out in our day to day. Over our long history, we've automated all sorts of jobs, right? We used to have an economy that was primarily agriculture, right? And now we have a more services-based economy. My favorite example to show, to really just bring this point home, is what happened to bank tellers when ATMs were spreading all over this country. Because ATMs stand for automated teller machines. That was a technology, just like the chatbot that maybe is picking up the phones, was point blank coming after bank tellers' jobs. But what we saw was, instead, for pretty much a decade, the employment of bank tellers grew almost at the same pace as ATMs were popping up all over the United States. And the reason is because ATMs allowed bank branches to run more efficiently. It allowed business to grow. They were opening bank branches in more rural and suburban areas. All of that led to greater demand for bank tellers, demand for workers. But the job of a bank teller changed. They were getting more sales training. They were now working on the expanded suite of offerings that bank branches were giving now. And they were getting a college education. And that has been the secular trend that we have seen when it just comes to the tasks that make up all of our day-to-day lives. We ran the numbers, and we looked at in our white paper that we wrote last year on the productivity question of how much of tasks that make up the workforce right now seem exposed to automation. And it's an imperfect science. But when you look at that 15 to 20% share that you quoted, that is not spread. That is not 5 to 20% of jobs. That's 5 to 20% of tasks. And each one of our jobs has a share of those tasks. But odds are the vast majority of jobs only have a small share of those tasks and can actually be augmented by automation and efficiency gains in those tasks. And we can spend more of our time on the other kind of tasks, like what we're doing right now and talking to one another. We spend an estimated 25% of our total working time just communicating with one another.
Mhm.
And what I expect to see is over the next 10 years, our jobs are just going to go more and more, shift more and more to those people skills. There's actually this report, the 2024 Future of Jobs report by the World Economic Forum, where they survey businesses and they ask them, what are the top skills that you are in demand right now when you're hiring? And the number one is creative thinking.
Uh-huh.
After that, it's analytical thinking, technological literacy. Like we're all going to need to be fluent in technology, but it's taking that and then layering on these more human soft skills.
And I think a lot of that, interestingly, is what we've maybe discounted to a certain degree over maybe the last 10 years. So it's interesting to see some of that stuff. The pendulum swings back the other way, maybe on a go forward basis.
Absolutely. One of the more interesting things that came out of the industrialization era was not just the growth of factories and factory jobs, but also the growth of things like arts and sciences. Like people had more money to spend more time on their hands because they weren't working these long hours and days in the fields, that it led to demand and for the birth of industries in all sorts of places. So no one has a crystal ball. We don't know how this is going to like really end up looking in the next 10 to 15 years, but I think history is a really important guide on that front. And if I may, I want to go back to the earlier point that you made on productivity, because that for us is just the holy grail when it comes to technology and economic growth. There's like two ways that you get an economy to grow. You either increase the size of its workforce or you make each worker more productive. Now, on the former, there's not a lot of room for or evidence for optimism, I guess. We have an aging demographic distribution. We haven't had a lot of immigration, and we've had a recent boom, but on a more secular basis, that's not expected to really grow. And productivity growth has been actually pretty lackluster in the past 10 years. It averaged just 1.4%, which is nearly like a secular trough for the last century and a half. But if AI is this new, what we call a general purpose technology, it's something like electricity, a computer, the steam engine. And if it's something that can automate 5 to 20% of our tasks, right? It suggests to us that there's some pretty meaningful ground for productivity upside from this, which really just means that, over the long term, this could lead to a lot more growth, hopefully higher, standards of living. I mean, improved healthcare services and tools and diagnoses and all sorts of real world problems where AI could really help us a lot.
Well, I think that's a good transition to my next question. But the steam engine example, I had heard you used it when you spoke elsewhere about how that was created for a totally different reason, and then they realized if we apply it to this, it could change everything. And so we're so early on some of the applications of this technology that we probably don't even really know, where this goes from here in terms of how it can be applied at its highest and best use, right?
Exactly. And even with the, dawn of the computer and the internet, could we have predicted that one day we would all rely on things like DoorDash for meals or Uber and Lyft, and that we would have this whole new economy of gig workers, right? Like, I don't think there were many people that expected that at the dawn of the internet in those very early use cases. So there's all sorts of transformation that we're just such early stages at even kind of comprehending.
So that brings us to the next chart we had, and this is one we pulled aside in a meeting with other team members at JP Morgan, because it's such a good, I think, visual of not only how markets evolve, but really how technology drives leadership and innovation drives market leadership, right? And that is not something, I think, when you're in it day to day, right? Like, okay, Apple's been around forever. Microsoft has been in our lives forever. And that's true to a certain degree. But when you zoom out the lens a little bit farther, you see how, we need to skate to where the puck is going, not necessarily where it is today. So if this is another major shift, and all signs seem to point to that it is, and investors are trying to get their arms around AI and all these changes, how does JP Morgan to think about positioning portfolios, for that long term. So you're not just getting that leadership of today, which you talked about, right? The picks and shovels, but also, 2030, sort of where that question mark sits today.
Yeah, absolutely. And we love this slide too, because I think it is so important to have some hindsight when it comes to who the leaders were in the global stock markets at different eras of technology. And I love to pull up this slide when I give presentations too, and I think it sends a lot of people back towards memory lane, right? In the 2000s, the leaders of the markets during the beginning of the internet were companies like Cisco and Intel and Nokia. In 2010, you had companies like Hewlett Packard and Samsung on this list still. And even a couple of years ago in 2020, when we showed on this list, NVIDIA wasn't on the list, right? And we look at the leaders of the markets today. There's a lot to be said for why they've been so magnificent. There's a lot of good, there's a lot of quality there. But what history has also told us is that these times of technological evolution have also been associated with pretty meaningful changes in market leadership. Now, some of these companies have stayed in the top 10. You mentioned Microsoft, right? That one's been on the list for some decades, and Apple too. But most others have changed a good deal. I mean, even this year alone, right? The tagline of Mag 7 has been debated. Is it Mag 7 or is it Fab 5 or is it just one company? And I think we're going to continue to see these changes in market leadership. And for us as investors, that is good news, right? That suggests there is still this opportunity when it comes to active management to identify who are the leaders today that can still be the leaders in 2030, and who are the ones that are perhaps outside of the scope of that Mag 7 of those top leaders that could end up really growing their market share and becoming a really dominant player in this field. And what we typically see too is as the technology matures and reaches different stages in its life cycle, you have different players and entrants that come in and can, end up being really big players. And I think when it comes to AI, we are in such early stages, which is characteristic of why we have only a few companies selling picks and shovels at record high profit margins. So we're optimistic and kind of open-minded to see how that transforms over the next few years.
I think as investors too, I think they look at this list and they try to cherry pick on the past, right? And they don't look, ahead. And I think being able to do that, represents a lot of risk, I think, right? Just to say, here are the 4 or 5 companies that I like, right? So, diversifying that and looking at that portfolio, in a way that you're not just picking 1 or 2 and trying to cherry pick. There's been a lot of drawdowns with these names. I'm looking on the list right now, significant drawdowns, over 50% from peak to trough. Sometimes the average investor gets scared out of the market. And I think that represents a longer term risk, for that longer term investor to be on the sidelines and miss that opportunity cost.
In our first conversation when we met, Stephanie, you had used one word that I think sums it up that we, could use more of a lot of times as investors, and that's humility, right? Like there's a lot of value today in being willing to say, I don't know what that top 10 is in 2030, but I can position myself to have good outcomes as an investor, even though I may not know those answers of that, where that question mark stands today.
Absolutely. And it's one of the reasons why, we show a lot of single names on this list, but that's not really the approach that we advise either. Sometimes when it comes to technological evolution, you actually don't need to get that cute with it, with trying to cherry pick the NVIDIAs of the basket, because for every NVIDIA, there's a whole bunch of other stocks that
there's Intel.
Yeah. So, and if AI is one of those technologies that boosts productivity, that should also be bullish for just earnings growth more broadly for the markets, for economic growth, for consumption, for some of these things that could serve as like a rising tide that lifts all boats. So it's, I think, a reason to stay invested and to be invested. But some of the volatility that we've seen in just, these names this year also provides a really important warning sign of just having too much of your money in like a few eggs in the basket, you know?
So to wrap it up, maybe along those lines, I saw an article in I think it was Barron's over the weekend, and it had mentioned like 4% of S&P 500 companies have implemented AI. I think was the way they put it, right? And so having that balance of risk versus reward in a portfolio is incredibly important, right? And everyone's situation is different, but maybe talk a little bit about how just broadly JP Morgan views, and you've talked a lot about it, but not just the future going forward when it comes to the economy and AI, but how to balance sort of that upside and downside from a broad perspective.
Yeah, see, that's a survey from the Census Bureau, which we've been following really closely, and I love it. I think it's a really great way to track business adoption of AI. And exactly to your point, we're in such very early innings, and we haven't really figured out the use cases of that, which to us, I think also bodes, that 4% stat is also probably one of those reasons why investors are now experiencing this kind of new wave of skepticism when it comes to AI, which is leading to some of these more choppier waters. And that should be expected. We've had this really remarkable run in the last year and a half, and we agree on the transformative nature of AI. But the other key thing is that 5% or 4% business adoption, right? That is not 50 to 60. This is such a long-term theme, and I don't know if it's prudent to expect that the winners today can really continue to achieve the same kind of upgrades in their demand projections over the next few quarters and years. So we are expecting some kind of moderation, and that's okay, right? This is like a long-term theme, but particularly using, I think, this period of, we're coming, back from our summer vacations, or maybe taking a closer look at where, portfolio allocations have gotten a bit misbalanced, and using that as an opportunity to rebalance portfolios towards other areas of the markets that seem to have still attractive fundamentals, whether it's just on the cyclical basis, we have interest rates coming down, we have a soft landing, but also the broadening out story when it comes to AI infrastructure, looking at energy, utilities, other areas of the market that could perform over the medium to long term as this progresses.
That's so great and very helpful, certainly for us, but I think for listeners and our clients too. So, Stephanie, thank you for taking the time today. Great conversation, and thanks to JP Morgan and your team for all the help and resources that you provide us to help serve our clients.
Thank you, Stephanie.
Of course, awesome. Thanks for having me.
The information in this interview is provided for informational purposes only and should not be taken as investment, legal, or tax advice. Opinions expressed in this interview are subject to change without notice. It is important to remember that investment in securities involves risk, including the potential loss of principal invested. Past performance is no guarantee of future results, and diversification does not guarantee a profit or protect against loss in a declining financial market. Alliance Wealth Advisors is an investment advisory firm that is independently owned and operated. Alliance does not make any representations as to the accuracy, timeliness, suitability, completeness, or relevance of any information prepared by this unaffiliated third party mentioned in this communication, and takes no responsibility. For more information regarding Alliance, please visit alliancewealthadvisors.com/legal disclosures. Thank you.